Hello and welcome back, ladies and gentlemen, to the second part of this two-part episode looking at the concept of domicile here on Collier Bristow's US-UK Tax and Estate Planning podcast. I am delighted to be joined again by Holly Payling from the accountancy firm Buzzacott. Holly, how are you?
I'm great, thanks, Aidan. How are you?
It's almost like it's only been 2 minutes since we were last recording. Now, when we were last here, we discussed what domicile is, what it means, and also what it's not, and how one becomes or avoids becoming US or UK domiciled. If you haven't had a chance to listen to that half of this two-part episode yet, please do go and take a listen. But of course, please do come back and listen to the second part as well. We're now, Holly and I, going to consider the consequences of being a US or a UK domiciliary, particularly from a tax perspective. If there's time, we'll look at some non-tax consequences as well. And Holly, I guess first, I'd like to think about the UK piece and the UK consequences of being a non-domiciliary. To my mind, there are broadly two benefits to being a non-domiciliary. One is an inheritance tax benefit and one is an income tax and capital gains tax benefit. From an inheritance tax perspective, and being a non-domiciliary, and I guess I should say here, when I say non-domiciliary, that's shorthand for non-domiciliary and non-deemed domiciliary, throwing it back to the first half of this episode. From an inheritance tax perspective, only your UK citus assets are broadly exposed to inheritance tax. And on an income tax and capital gains tax perspective, it affords you the ability to elect into the remittance basis of taxation. Do you agree that those, Holly, are the most sort of important benefits? And shall we unpack kind of in a bit more detail what those mean?
Yeah. So shall we start with the inheritance tax position?
Sure.
I think that kind of sometimes worries people the most.
Yeah.
The main way it affects inheritance tax, as Aidan just said, is that if you're a non-UK dom or deemed dom, then you'll only pay UK inheritance tax on your UK citus asset. So a lot of people, that will mainly be a UK property, that be a real estate property. Could also include things like bank account. So how that would vary once you become domiciled is your worldwide estate will become subject to UK inheritance tax. And that can be quite a big shock for a lot of people, as our exemption is very low. So it's £325,000. Anything above that, there'll be a 40% UK inheritance tax. And especially for US UK clients, they have in the US a much more generous exemption of kind of almost $13 million. So that's kind of really where people need to focus and have a look at the advice about what becoming deemed domicile means.
Yeah. So, I mean, on a sort of a fundamental planning level, what a lot of non-domiciliaries, not just Americans, but non-domiciliaries end up doing is sort of limiting the amount of wealth they keep in the UK, because that's just from a kind of an insurance perspective. The less you keep in the UK, the lower your risk of UK taxation is if you pass away as a non-domiciliary, certainly until the point at which you become a deemed domiciliary after 15 years. The other thing to sort of signpost here, which we'll come on to in a little bit, is Holly rightly mentioned becoming exposed to inheritance tax on a worldwide basis if you are a deemed UK domiciliary or a UK domiciliary. Of course, to an American, they are already exposed to worldwide estate taxation by virtue of being a US domiciliary. Let's say they're a US citizen. So you have two countries now competing to tax you on a worldwide basis. And then we get into the sort of separate discussion of double domiciliaries, i.e. someone who's domiciled in two different countries at once. And what do we do in those circumstances? That's the end of my coda there. We'll come back to that a little bit later. I guess, Holly, on a day-to-day basis, the remittance basis of taxation is one that you are dealing with more frequently with clients from an income tax and capital gains tax perspective. Certainly, as regards Americans, what's your personal view or Buzzacott's house view on sort of the use of the remittance basis for Americans? I guess actually we should probably confirm what the remittance basis is first. Yeah.
Yeah, so the remittance basis, so the default UK position is that everyone files on what's called the UK arising basis. So that'll be reporting their worldwide income and capital gains on their UK tax return. So for a non-domiciled person, there's an option to pay UK tax on just your UK source income and capital gains, and then on any non-UK income and gains that you actually bring to the UK. Where it's interesting for a US taxpayer would be they're already paying US tax on their worldwide income. So is excluding this income or capital gain actually going to save any UK tax when you're filing on the remittance basis? So we'd want to run some calculations and see, does it make sense? You don't want to save a couple of £1,000, at the cost of later a much higher compliance bill. and also another reason is if you're making this remittance basis claim, you need to segregate that money that you're not paying tax on and make sure you then don't bring it to the UK at a later date. So you couldn't exclude a big income event in year 1 and then in year 10, if you're still here, bring it here. If you did that, then you're going to have a UK tax charge, which can potentially lead to double tax as well. So for a lot of Americans living in the UK, they would just ignore the remittance basis and just pay tax on everything, making claims under the US-UK income tax treaty.
The idiom I use to clients sometimes is that if you think you're ever going, or Americans, is that if you think you're ever going to need that money in the UK, then it's actually better to steer into the skid, except that your car is skidding, pay the tax in both jurisdictions at the same time, because then, a good firm like Holly's will help you get a credit wherever possible for the tax you've already paid, and better to possibly incur maybe a few percentage points more of income tax because the UK rates are, a couple of points higher than in the US. But as a result, you can then bring money to and from the UK entirely freely. You're right, Holly. It's a computation exercise for every client, isn't it?
And also, another important thing, get the advice before you move here. Because there might be things that we'd rearrange so that it's better from a UK tax perspective, so that position going forward is much cleaner or cheaper, basically, for UK tax purposes. So
Holly has very kindly left me an open goal to remind listeners about the very first episode of this podcast that I did with my colleague Charlie Fowler about pre-immigration and pre-arrival tax planning, and also the podcast I did with Ollie Cutting at Maseko about sort of pre-arrival investment management planning. Holly, that was a very, very kind open goal you left me. From a US perspective, again, the concept of domicile is, on the one hand, easier, because the answer is, when you're a US domiciliary, the IRS is just going to tax you on everything as a basic rule. But how does sort of US domicile status affect clients, Holly, for income tax purposes first, I guess, if they've got foreign or US source income?
Yeah, so if you're US domicile, so that would include passport holders and pretty much all green card holders, and anyone that's also just a US resident, having a look at their residence rules, you're going to pay US tax on your worldwide income and capital gains from the moment you become US resident. So there's no kind of generous provision for people arriving there. They get you as soon as you become US resident. So that'll be, everything will go on your return. There'll be elements of double taxation reliefs. However, you just need to be aware that you go fully into that system as soon as you kind of get into the US domicile net.
And then from an estate tax perspective, or I should say a gift and estate tax perspective in the US, the position is, again, conceptually same to the UK, which is that the Americans don't like wealth leaving their estate tax net. The UK has sort of, broadly similar rules, which is where you are leaving wealth to a non-national or a non-domiciliary, the tax authorities want to limit your ability to give money away tax-free, because if you give money away sort of to someone who's non-domiciled, I guess from a policy perspective, you're more likely to take that money offshore and then it can't be taxed anymore. So in the UK, for example, we have strictly a limited spouse exemption where you're leaving money to where a UK domiciliary is leaving money to a non-domiciliary. And in the same way, if you are a recipient of wealth and you are an American citizen, you receive money from your spouse, you're always going to get an allowance. And I guess, like I said, because from a public policy perspective, the IRS is confident that money is going to stay within the tax net. But if you leave wealth to a non-citizen spouse, you don't get the same ability to roll over any unused marital deduction. And indeed, you don't get a marital deduction at all. He says in parentheses, I understand that because I'm not the US practitioner on this call. But generally, Holly, when you are talking to clients about these kind of topics, for a lot of clients living in the UK, these are relatively remote issues if their wealth is under the estate tax allowance, because if their wealth as an individual or even as a couple is worth less than the prevailing allowance, as you said, currently almost 13 million, it doesn't really matter whether they have a marital deduction, whether they can roll it over, whether they have generation skipping, transfer tax exposure or not, because there's no estate tax on their death anyway.
Yeah, that's right. So for two US domiciliaries married to each other and living in the UK, they wouldn't really need to think too much about estate tax in their lifetimes, as at the moment they've got the $13 million exclusion each. So unless their estate's going over 26 million US dollars, then US estate or domicile doesn't really make much difference for estate tax purposes. That's set to sunset. So right at the end of 2025, it will go back to $5 million each, adjusted for inflation. But that's still a much more generous concept than the £325,000 that small exemption that we have in the UK. So where people could get out, kind of caught out, is if one of the spouses is American domiciled and one of them isn't, which is just fairly common. People come over here and get married. In that situation, there wouldn't be an unlimited spousal exemption between them. So if the US spouse was set to die first with $20 million of assets, they'd only have one set of that $13 million exemption. So that could lead to an immediate charge to estate tax. There can be quite a bit of clever planning. I think it's involving a qualified domestic trust. Aidan, I think maybe that's something you might kind of get involved with the mechanics more. How does that work?
Yeah, quite frequently. So if you've got an American, and we discussed this in the will planning discussion episode. Again, Holly, wonderful open goal there with Chris McElmore of McElmore Konchnik. If you're an American domiciliary leaving wealth to a non-domiciliary for US purposes, then if you want to leave wealth in excess of the estate tax allowance, then really you need to leave that wealth on a qualifying domestic trust or a QDOT for the amount over currently $13 million or, over whatever it will be once it's sunset, 6 or 7 million. A QDOT is conceptually similar to a life interest trust, which we use for UK estate planning for will planning purposes, but not exactly the same. They're slightly more inflexible. So marrying the two together is an art more than a science, but we can usually get to an outcome which satisfies both regimes fairly tax efficiently.
I thought I might mention just quickly what happens for non-US domicile and they have US assets, because we mentioned what happened for a non-UK domicile. You're just exposed to UK real estate for inheritance tax purposes. And it's a very similar situation if you're a non-US domiciled person and you die with US assets. So that could be things like US real estate. It also includes things like US pension. So the answer there is it will be subject to US estate tax. It's something just to be aware of. The exemption is much lower, so looking at $60,000 rather than the almost $13 million.
I've always been staggered about the difference between those two allowances, and not least because I think the $60,000 is not index linked, whereas the main allowance is, and so it's been $60,000 for quite a long time.
Yeah, and I'm actually writing an article about it at the moment. So if anyone wants to read more, I can just dig into that.
Again, look, you left off your own open goal there, Holly. If ever there was a better example of the way in which the American government looks after their own rather than looking after quote-unquote foreign people, there's an example right there in the tax code. Conscious with the time we have left, I do want to touch briefly on this concept of double domiciliaries, which I mentioned previously, which is to say, what if you find yourself as an individual who is exposed to the domicile rules in both the US and the UK at the same time, because, for example, you're a US citizen who's lived in the UK for more than 15 consecutive years? The answer is that the US and UK have a capital taxes treaty or a gift and estate tax treaty, which deals with this scenario precisely. This should be technically distinguished from the double tax treaty that deals with income tax and capital gains tax. The gift and estate tax treaty largely gives the rules for what happens if you are a double domiciliary and which country has the primary right of taxation. And that is usually determined by a series of tiebreaker tests where the individual's fact pattern, their background is assessed and determination is made as to which jurisdiction they are more closely related. Sort of a fairly decent sort of 30-second summary, Holly?
Yeah, that's really useful. And it's definitely something dual domiciles can look at. And if sometimes it can just be a way of escaping the UK inheritance tax system, as it's so much more aggressive than just looking at these different ties. We won't go into too much detail. It's definitely something to take advice on if you're thinking of moving back to the US. How do you get rid of the UK problem, basically?
Yes, exactly. And then the last thing I wanted to touch on was just a couple of examples of way in which domicile status is slightly broader, or the consequences of being a domiciliary are slightly broader than just the tax consequences. And I mentioned to Holly offline that there are principally three that we as lawyers deal with most commonly. One of which is regarding claims under the UK's 1975 Act, which is the Inheritance Provision for Family Independence Act 1975, which, again, we had an entire episode on with my colleague Samara Dutton, but is the only limiting factor on an individual's testamentary freedom, really, for UK purposes, where an aggrieved party can bring a claim for insufficient financial provision under an estate if they've been left out under a will, for example. You can only bring a claim against the estate of a UK domiciliary, and their deemed domicile status has no consequence. The second way in which domicile status arises in a sort of estate planning succession non-tax law perspective is that the succession law that governs the devolution of your movable assets for UK purposes, being effectively your non-real estate, is governed according to what's called lex domicilii, or the law of your domicile. So if you are an American domiciliary and you have bank accounts in the UK, then strictly speaking, the law that governs how you can leave those bank accounts is determined by the relevant state that you are a domiciliary of. Broadly speaking, most US states have testamentary freedom as well. I think, is it Louisiana, the one remaining sort of French origin state that has some forced heirship rules, I think. And the third consequence is, as regards a domicile, is divorce, and your ability to bring divorce proceedings in different jurisdictions can be associated with your domicile status. And if you're not a domiciliary, or if you are a domiciliary, you'll find it harder or easier to bring divorce proceedings in the UK. But I guess each of those topics is worthy of their own podcast, and maybe we'll have to pencil another time to go through those. Holly, anything else that you think we've missed off of our lengthy chat today that you think people need to know about?
No, I think that's been very, very conclusive and insightful.
Marvellous. In which case, I think that probably draws today's discussion to a close, and this two-part episode to a close as well. That just leaves me to thank Holly Payling again for her time today. If you are an American listening to this episode, or indeed anyone who you think is in need of Holly's services, then I have no doubt if you search for Buzzacott and search for Holly's name, you will find them quite easily. In the meantime, until next time, thank you for joining us. Please leave us a rating or a review. We'd be delighted to hear from you, and we will see you next time. Thank you very much.